Welcome to Dad Gives Advice. My name is Orestes, and in this video I'm continuing my series on investment vehicles or securities. And today I want to talk about ETFs, or exchange traded funds. Before I get started though, I want to remind everyone that these videos are for educational and informational purposes only, and anything I say here should not be taken as individual or personalized investment advice. You should always seek the help of a personalized investment advisor when making investment decisions, and you should not take any action before you do so. So what are ETFs? These are, like I said, exchange traded funds. And as the name implies, these are kind of like mutual funds, but they are actually traded on a stock exchange, or what they call the secondary market. Like mutual funds, ETFs are investment vehicles that track either an entire market or a market index or a group of securities. So they're very similar to mutual funds in that way. There are some significant differences to mutual funds, however. For example, mutual funds are bought continuously from the issuing company. In that way, when you buy shares of a mutual fund, you're essentially buying them directly from the mutual fund company that's offering that security. ETFs are issued in a different way. They're issued in something called creation units. And the creation units are essentially large blocks of shares. So they could be like 50,000 or 100,000 shares. And those are bought by large institutions, typically broker-dealers. So broker-dealers will buy the creation units, and then they will make markets on the individual shares on the exchanges. And in that way, ETFs will trade just like stocks. The market maker will make a market in those shares, and investors will either buy or sell shares through the market maker. So because they trade like stocks on the secondary market, ETFs will trade intraday. Unlike mutual funds that trade at the end of the day. So intraday trading means that the price will fluctuate throughout the day. Along with the underlying securities. So for example, if an ETF tracks the S&P 500, then the shares of the ETF will actually fluctuate in price as the underlying stocks within the S&P 500 fluctuate throughout the day. If you saw my mutual funds video, you saw that I talked about a lot of different stock index or market index mutual funds that are out there. Well, there are also ETFs that track the same kinds of market indexes. So you can find, like I've mentioned before, an ETF that tracks the S&P 500. You can find ETFs that match each one of the 2x3 or 3x3 matrix that I talked about under the different equity funds that you could find, or the equity index funds you can find. So you can find like a large cap growth, large cap value, mid cap growth, and so on and so forth. ETFs, just like you could find mutual funds in those segments. Just like mutual funds, there's a huge number of ETFs tracking different market indexes or different industries, or even niche things like precious metals or cryptocurrencies. There are also inverse ETFs. So if you believe that it's time that let's say if a market is going up and you believe it's at a peak, you could, at this point, buy an inverse ETF on that market because you expect the market to drop. And as it drops, the inverse ETF will actually go up. So inverse meaning it does the opposite, essentially, of what the index it's tracking does. And there's also leveraged ETFs that will allow an investor to leverage their cash, leverage their investment. By that, I mean that you are actually working with 2x or 3 times the cash that you're actually using. You're leveraging your cash. And the underlying ETF is doing that by buying individual securities, but also buying derivatives of those securities, things like options and futures and contracts like that. I'll probably talk about options and these other esoteric instruments in a separate video. So with leveraged ETFs, you are potentially able to multiply your gains because you are investing in these ETFs that will use these derivatives that allow you to leverage your investment. But they're very risky because you could also multiply your losses in the same way. If you saw my video on index fund investing, you know that I prefer index mutual funds and I prefer those to ETFs because I don't want the temptation of being able to trade intraday. My strategy is long-term investment in low-cost index funds, so the ability to trade intraday really has no appeal to me. And it can be a bit of a temptation that I want to avoid. Remember too that I talked about the more often you sell stocks or mutual funds, the more taxable events there are. And so that's another thing that I try to avoid with long-term index fund investment. So again, the fact that you can trade ETFs multiple times throughout the year has no appeal to me because I want to hold for long-term over several years. There are some articles out there on the internet and some people that'll say that ETFs can be more tax efficient than mutual funds. And that could be true under very specific circumstances. But again, when you're comparing them to index funds, that advantage disappears. I'll explain why. There are times when mutual funds will be forced to sell shares, and that is so that they can keep their percentages in balance with respect to the index that they're tracking. When they do sell those shares, that is a taxable event to shareholders. So even if the shareholders are not selling their own mutual fund shares themselves, they can get a taxable event and have to pay taxes on capital gains at the end of the year because of these events where the mutual fund has to sell some shares. Now, if you saw my video on mutual funds again, you know that index funds don't have this problem as much as other mutual funds because they tend to hold for a much longer term and they don't need to sell as often. You saw the one example where it showed an index mutual fund that had an 8% turnover, a very low amount of sales that they are doing every year. So this advantage of tax efficiency for an ETF is really when you're comparing an ETF to a managed fund that might have more sales and more capital gains on a year-to-year basis. And again, I don't use those, I use index funds. So for me, this ETF advantage kind of disappears. There's also a bit of a downside on ETFs that they have the same kind of spread that stocks do. Because they trade on exchanges, there's going to be that old bid and ask spread that we talked about when we talked about stocks and some managed mutual funds. So in this example, it's going to cost you every time you buy an ETF or sell an ETF, you're going to have to pay the spread because the company that's making the market for it will want to make some money on it. And some ETFs happen to have a very large spread, so you got to watch out for that. So those costs of trading the ETF could eat away at some of your profits or make your losses even wider. And you can compare this to the index funds that I like, which are no-load index funds where there is no spread. You're always buying and selling at the NAV or net asset value. The bottom line for me is that I use low-cost index funds over the long haul to track the gains of the market. So I don't need intraday trading that ETFs afford, and I don't want the temptation of intraday trading either. You can see a nice article comparing ETFs, managed mutual funds, and index funds on the Schwab website, and I'll post a link on the video and in the notes. Let me know if you have any questions on ETFs and if there's any other topics that you'd like me to cover. Thanks very much for watching and have a great day.